Lesson 10. How to choose the right trading pairs. Let me paint you a picture you've probably already lived through. You've spent weeks tuning a strategy. Your backtest on Bitcoin looks beautiful. 25% return over 6 months, win rate above 80, drawdown under 7. You feel like you've cracked it. So you take the exact same logic, run it on some random small altcoin you heard about on Twitter, and the backtest shows 90% return in 2 months. You are already mentally shopping for a boat. Then you go live on the altcoin. A month later you are down 12%. Your fills are all over the place. Your stop losses trigger at prices you never saw on the chart. And the backtest's 90% return has turned into a real loss. Here is what I want you to take from this lesson before anything else. The trading pair is half the strategy. A good strategy on the wrong pair is a bad strategy. And a lot of the gap between beautiful backtests and disappointing live results comes down to picking the wrong pairs. Why pairs matter so much when you build a strategy. You are not building a magic formula that works everywhere. You are building a set of rules that exploits a specific kind of price behavior. A trend-following strategy needs pairs that actually trend. A breakout strategy needs pairs that move hard when they break. A mean-reversion strategy needs pairs that bounce between extremes. Take trend-following logic and run it on a pair that just sits flat, and you'll bleed money slowly and wonder why your backtest lied to you. There is a second layer that catches everyone. Even when a strategy fits a pair's behavior, the pair has to be tradable. It has to have enough volume that you can buy and sell at the prices you see. It has to be stable enough that the gap between bid and ask doesn't eat your profits. Plenty of pairs look amazing in backtests and fall apart in live trading because of this. Pair selection is partly about fit and partly about survival. The 3 tiers, blue chips, mid-caps, altcoins, crypto trading pairs roughly split into 3 tiers, and you should know which tier you are in before you trade anything. Blue chips are the top 10 to 20 coins by market cap. Bitcoin, Ethereum, BNB, Solana, XRP, Cardano. These trade over $1 billion a day in volume. Their daily moves are usually 2 to 5%. The spread between bid and ask is essentially zero. They're hard to manipulate, and the information about them is public and constant. They're the safe end of the pool. The trade-off is that returns are modest. You are not going to tank your money swing trading Bitcoin in a week. Mid-caps sit at ranks 20 to 100. Things like Chainlink, Polygon, Uniswap, Avalanche, Cosmos. Volume is solid, usually in the hundreds of millions a day. Volatility is higher, with daily moves of 5 to 10% being normal. These give you more room for profit, but also more rope to hang yourself. They're a reasonable middle ground once you've got a working strategy. Altcoins are everything below rank 100. Volume can be tiny. Daily moves of 20% or more are common, and the spread between bid and ask can be brutal. Information is asymmetric, meaning the people trading against you often know things you don't. Some of these coins have backtests that look like winning the lottery. That is not a feature. It is a warning. My honest advice for beginners is to spend your first few months on blue chips only. Bitcoin, Ethereum, maybe BNB. Get the strategy right, get the discipline right, and only then start adding mid-caps. Leave the altcoins alone until you've been through a real drawdown and learned how it feels. Liquidity, the boring thing that actually matters. The single most underrated concept in crypto trading is liquidity. Liquidity just means how easily you can buy or sell without moving the price. The more liquid a pair, the closer your actual fill price is to the price on your screen. The less liquid, the more you pay in hidden costs. There are 3 things to look at. The first is 24-hour trading volume. As a rough scale, anything over $500 million a day is excellent. 100 to 500 million is good. 20 to 100 million is average. And below 5 million is dangerous. Bitcoin does tens of billions. A random small coin might do 1 million or 2. You can check these numbers on CoinMarketCap or CoinGecko in about 10 seconds, and you should make it a habit. The second is order book depth. When you open the depth chart on an exchange, you are looking at how many buy and sell orders are stacked at different price levels. Good depth means there are big orders sitting close to the current price. So when you place an order, there are enough counterparties to absorb it without the price jumping. Poor depth means a relatively small order can shove the price around. On blue chips, the book is thick. On small coins, it can be a desert. The third is the bid-ask spread. The bid is the highest price someone is willing to buy at. The ask is the lowest price someone is willing to sell at. And the gap between them is a direct cost to you on every single trade. On Bitcoin, the spread is often near zero, something like 1 basis point. On a thin altcoin, the spread can be 0.5% or more. 0.5% doesn't sound like much until you realize you pay it on entry and exit on every trade. A strategy that targets 2% profits loses a quarter of its edge to spread alone. Slippage, the silent killer. Now connect those three things together, and you get slippage, which is the gap between what your backtest thinks you got filled at and what you actually got filled at in live trading. Here is how it bites you. Your backtest assumes you bought at exactly $100 and sold at exactly $102 for a clean 2% profit. In live trading, because the book is thin and your order is bigger than the orders waiting there, your buy fills at 100.20 and your sell fills at 101.60. That is a 1.4% profit, and you've lost 30% of your edge to slippage before fees. On a low liquidity pair, the slippage can wipe out the edge entirely, and the strategy that printed money in backtest quietly bleeds in production. This is why I keep saying liquidity over return potential. A strategy making 3% per trade on Bitcoin with near zero slippage is real money. A strategy making 8% per trade on a thin altcoin with 4% slippage is an illusion. The backtest will always look better on the altcoin. That is exactly the trap. Volatility. Matching the pair to the strategy. Volatility is how much a pair moves in a given period, and it determines what kind of strategy can work. A simple way to think about it is the daily range, the gap between the day's high and low as a percentage of price. Below 2% is very low, that is stablecoin territory, basically ARB only. 2 to 5% is Bitcoin and Ethereum, which suits trend following. 5 to 10% is mid-caps, a balanced zone. 10 to 20% is hot altcoins, which is where short-term breakout strategies live. Above 20% is small-cap chaos, which I don't recommend anyone trade with size. The honest trade-off is that high volatility gives you bigger profit windows, but also more false breakouts, more stop-loss hits, and bigger drawdowns. Low volatility is steadier and easier on the nerves, but the profit per trade is smaller, and you get fewer signals. The strategy has to match. If you are trading a pair that swings 15% a day, a 3% stop loss will get hit constantly on noise. You need to widen the stop out to something like 10% and lift your take profit target to match, maybe 15%. If you are trading Bitcoin at 3% daily range, that same 15% target may never get hit, so you drop it to 5% and tighten the stop to 3. The numbers are not universal. They depend on the pair's natural rhythm. This is something I see people miss all the time. They copy a strategy from a tutorial, run it unchanged on 5 different pairs, and get 5 wildly different results. Most of the time, the strategy wasn't wrong for any of them. It was tuned for a specific volatility, and they didn't adjust. Why you want more than one pair if you only trade one pair? You are tied to that pair's regime. Bitcoin goes sideways for 6 months. Your strategy generates nothing. You get bored. You start fiddling with parameters, you break it. That is a true story for a lot of people. Or Bitcoin crashes and your stop loss triggers, and you eat a loss you can't offset anywhere. Trading multiple pairs fixes this. Different pairs have different regimes at the same time. One is trending up, one is choppy, one is breaking out. A strategy that fires signals across 5 pairs will give you more opportunities, smoother returns, and lower drawdowns, because the bad luck on one pair gets averaged with neutral or good luck on the others. There is a real backtest comparison I want you to hold on to. A strategy on Bitcoin alone over a 3-month window might return 8% with a 6% drawdown. The same strategy across Bitcoin, Ethereum, and BNB might return closer to 25% combined, with a lower drawdown around 5%. The strategy didn't get smarter, the diversification did the work. Correlation, the catch nobody mentions, but there is a catch, and it is the one that ruins most multi-pair portfolios. If all your pairs move together, you don't have diversification. You have the same bet 5 times. Correlation just measures how similarly 2 pairs move. Perfect positive correlation is 1, meaning they go up and down in lockstep. 0 is no relationship. -1 means they move opposite. Bitcoin and Ethereum have a correlation around 0.85, which is very high. Bitcoin and a stablecoin pair are close to 0. The rule of thumb I'd give you is to aim for correlations between 0.5 and 0.8 across your portfolio. Above 0.9 you've added nothing. You've just doubled down. Below 0.3, you are probably reaching into pairs that don't really fit your strategy, over-diversifying into noise. The sweet spot is a handful of pairs that are related enough to share the strategy's logic, but different enough that they don't all crash together. A reasonable starter portfolio is something like 40% Bitcoin, 40% Ethereum, 20% BNB. That is conservative. It is high correlation, but it is all blue chips and you are learning. As you get comfortable, you shift toward a balanced mix, maybe 30% Bitcoin, 25% Ethereum, 20% Solana, 15% Polygon. That is correlation in the 0.6 to 0.8 range, real diversification without reaching for trouble. How to actually test this in Freqtrade? The workflow in Freqtrade is straightforward. First, you download data for the pairs you are considering, something like 90 days of daily candles at minimum. More is better. Then you backtest your strategy on each pair individually. You are looking for pairs where total profit is reasonable, win rate is above 70%, and the maximum drawdown is under 10%. Anything that fails those bars on its own probably won't help in a portfolio. Then you take the 3 or 4 best performing individual pairs and run a single backtest across all of them together. Freqtrade handles the combination automatically. You just list the pairs in your config file or pass them on the command line and run the backtest. Compare the combined result to the single best pair. You want to see the combined return higher than any individual pair, and the combined drawdown lower. If that is what you see, the portfolio is working. If the combined drawdown is the same as the single pair, your pairs are too correlated and you haven't diversified anything. A note on the backtest report itself. Freqtrade gives you a per-pair breakdown with trades, average profit, total profit, and win rate. Read it. The story it tells is where you learn. The best performing pair by total profit isn't always the one you'd guess. The most stable pair by win rate might not be the most profitable. The pair with the most trades tells you which one fits your strategy tightest. This kind of pattern recognition is what turns into real skill over time. A few honest caveats first. The correlations you compute on historical data won't necessarily hold in live trading, because correlations shift with market regime. In a panic, everything correlated to risk drops together. That is exactly when diversification was supposed to save you, and often doesn't. Second, altcoin backtests are seductive in a way that I think borders on dishonest. A coin that moved 200% in a month will produce a backtest that looks incredible regardless of strategy quality. You are not a genius for finding it. You are looking at survivorship in a small sample. Third, your portfolio needs maintenance. Pairs fall out of favor. Volume dries up, new pairs emerge. What worked in the second quarter might not be the right set in the fourth. Plan to rerun your individual pair backtests every couple of months and adjust. Fourth, and I'll keep saying this in every lesson, paper trade before you go live with real money. A multi-pair portfolio has more moving parts and more ways to surprise you. The dress rehearsal exists for a reason. If you take one thing from this lesson, take this. Pick liquid pairs you understand, match your strategy's parameters to the pair's volatility, and diversify only across pairs that aren't perfectly correlated. That is most of it. The rest is just testing and paying attention.